So in this video, we are going to look at currency rate and currency rate risk. So we'll start with the basic definitions about exchange rates. An exchange rate is the rate at which one country's currency can be traded in exchange for another country's currency. So assume that you have $1. That $1 can be like converted into 70 rupees. Okay. So that is what is exchange rate is all about. The spot rate is the exchange rate currently offered on a particular currency for immediate delivery. So spot rate is like if you have $1 in your hand, okay, you can go to any forex bank and if you give that $1, you will get 70 rupees. So that is a spot rate. A forward rate is an exchange rate set now for currencies to be exchanged at a future date. So assume that you enter into a contract. The contract states that in 1 month time, you will give the forex company $1, okay, and that company should give you around 75 rupee, okay. So this is a forward rate. So the forward rate works like this: $1 to 75 rupees, okay. So forward rate is always in terms of a future period where you are promising to give $1, and you are also like promising, and you are also like asking the promise of another party to pay you the other amount. So that is about the forward rate. If the forex quote for rupee is 65 to 66 to the dollar, okay, so usually the rate is given in a parity, and you will have like two numbers for the rupee to $1. So now the question arises whether you will get or pay 65 or 66. So that is a question here. When you receive income of $100, okay, when your income is $100, then which you will choose? You have to choose the number where you suffer a lot, okay, where you suffer a lot. So you have $100 as an income in your pocket, and you go to a bank. If you're going to convert it at 65, you will get 6,500. If you convert the $100 into 66, you will get 6,600. So in which of this you suffer a lot? This one. So that is the exchange rate, okay. So in terms of an income, you should always get the lower amount, or you should always suffer. So that is about the rule. So the next rule is, when you have an expense to pay of $100, then which quote you are going to use? You have to choose the quote which makes you to pay a lot of money. So again you have to suffer, okay. For example, if you are given a choice to pay 6,500 or 6,600, which one you suffer a lot? 6,600 you suffer a lot. So you have to choose 66, okay. See, it's not about you choosing, it's about the bank offering you, okay. So whenever you give them $100, they will give you 6,500. When you want $100, then they will ask you to pay 6,600 to them, because the difference between the number, okay, the difference between the two numbers is the bank's forex profit, okay. So for them to earn a profit, that's why they have a parity like this. So you can remember the like this: whenever you get an income, you have to get a lower income. Whenever you're going to pay, you have to pay a higher payment, okay. So that's how the rule for forex works. So you are always at a loss. So here we look at the various types of foreign currency risk. So there are like three types of risk. One is called as transaction risk, translation risk, and economic risk. So from an exam point of view, these risks are very important. So we'll start from the transaction risk. So transaction risk is the risk of adverse exchange rate movement occurring in the course of normal international trading transactions, okay. So assume that you are going to export something or you are going to import something. Usually when you are going to export or import, a lag in the payment or receiving of the amount. So in such cases, you'll end up with the transaction risk. This arises when the prices of imports or exports are fixed in foreign currency terms and there's a movement in the exchange rate between the date when the price is agreed and the date when the cash is paid or received in the settlement. Okay, so transaction risk occurs when the goods bought is in the other country's terms. For example, when you buy a good, if the good is going to be priced in rupee, then you don't have any forex or transaction risk. But if the same good is going to be priced in dollar, then you will be like ending up with the transaction risk. The great danger to profit margin is in the movement of exchange rates. The risk is faced by exporters who invoice in foreign currency and importers who pay in foreign currency. Okay, so it affects the exporters and importers only when the payment or income is to be made in a foreign currency. So we'll have an example. Assume that ABC Co. It is an Indian company. It is selling a good to US and the promised payment is $1. And today's day rate is $1 is 75 rupees. And XYZ Co. in USA has received the goods and also makes a promise that they will pay in 3 months' time. So XY Co. in US has made the payment after 3 months' time to the Indian company. So the Indian company has received $1. So now there are like two scenarios here. Okay, so scenario one is the Indian company has got the $1 from the US company, but now they go to the bank. When they go to the bank, the rate is 60. The actual rate they thought for $1 to 75 rupee. That is what was fixed at the time of entering into the trade. But now they have got the $1. So the foreign US company has made its part very clear and they have paid the $1. But when converting this $1 to the bank, the Indian company gets only 60 rupees. So now there's a problem here. The company has effectively incurred a loss of 15 rupees because they thought they will get 75, but now they are getting only 60 rupees for a dollar. So they are getting a loss of 15 rupees. But it's not that they will incur a loss. For example, there can also be a scenario where the US company has made the payment of $1, and when they go to the bank in 3 months' time, and the $1 becomes 90 rupees, so the company can now effectively get 90 rupees. So they thought they will get 75 rupees, but now they are getting 90 rupees. So that is an additional profit of 15 rupees. So which scenario will work out, we'll never know in reality. So what happens is, and companies don't want to take this transaction risk, so better what they do is they try to go and do something called a hedging. Okay, they do something called a hedging mechanism. So this is about the foreign currency risk transaction. So this is about the transaction risk. So now we look at the translation risk. Translation risk is a risk that the organization will make losses when the accounting results of its foreign currency branches or subsidiaries are translated into the home currency. We look an example at translation risk. So an Indian company wants to invest in a foreign subsidiary and they have chosen UK as their destination. The Indian company is investing 13.5 crore. So what happens is 10 crore is for the real estate, 2 crore is for the inventory, and 1.5 crore is for the cash. So when it is being like converted into the UK currency, it becomes like 10 lakhs of real estate, 2 lakhs of inventories, and 1.5 lakhs of cash. So totally it becomes 13 lakh 50,000 of assets. So after a 1 year period, what happens is in 2003 31st March, okay, the value of the currency changes from 1 pound to 100 rupees to 1 pound to 85 rupees. So the value in pounds has not been changed. See, this value is the same as this value. These values have not changed, they are fixed. But look at the translated value. The translated value now changes. So the value here, which was 10 crore, has become 8.5 crore. The value here it was 2 crore, it has become 1.7 crore. The value here it was 1.5 crore, that has become to 12.75 crore. So put together, the value of the company has fallen down. So what happens here is the value of the UK subsidiary is stable, it is the same, but the value in terms of translated value it has fallen. Okay, it can fall or it can even rise. It's not about falling, it can also rise. For example, if 1 pound becomes 120 rupees, the value will be higher. Okay, the translated value will be higher, but either way this is a currency risk. So now we look at the theory for this. Translation risk is a risk that the organization will make exchange losses when the accounting results of its foreign branches or subsidiaries are translated into home currency. So the translation risk occurs when the UK subsidiary value is being like converted into the Indian value, then only the value keeps going up or down. Translation losses can result, for example, from restating the book value of a foreign subsidiary's asset at the exchange rate on the financial statement position date. Okay, so what happens is only when you convert it from one currency value to another currency value, the loss or gain occurs. The effect of translation risk is to create gains or losses in the reported financial results of the parent group, but they do not create cash flow gains or losses. Okay, so by the changes in the value of subsidiary, there is no income or loss that has been gained because the UK subsidiary's value is the same. Only when it's converted into the Indian currency value, the loss occurs. Okay, so you don't, this is loss is only a notional loss, it is only a namesake loss, it is not a real loss. So we'll move on to the next risk. It is called as economic risk. So this refers to the effect of exchange rate movement on the international competitiveness of a company and refers to the effect on the present value of the longer term cash flows. Okay, so what happens here is economic risk affects the competitiveness of a company and it also affects the longer term cash flow generating capacity of a company. It is the risk that over a time, the currency will depreciate or appreciate in value against other currencies so that a country's economy becomes more or less competitive. Okay, so it is not about only your currency keeps moving up or down, it is also your competitor's currency which keeps moving up or down that affects your company. So if you take okay, so even though the dollar and rupee parity might be stable, if the parity between the dollar and pound is going to change, it's going to change to like this. Even this has an indirect effect on the rupee. Okay, so that is the problem. We'll have an example for this. Assume that there's a US company and it buys shirts from India and Bangladesh at $1. So the rate today is $1 is equal to 70 Indian rupees and $1 is equal to 70 Bangladesh rupees. So India, what they do is for every shirt they sell, okay, as the parity is 70, their each shirt takes a cost of 60 rupees and they incur a profit. They incur a profit of 10 rupees per shirt. In the same way, the Bangladesh company also is like selling each shirt at $1. So they also get 70 rupee. So 70, the cost of manufacturing the shirt is 60 and their profit is 10. Now there is a change in the scenario. At 1 year end, what happens is the Bangladesh rupee's value changes, even though the Indian rupee value stays the same. The Bangladesh rupee value falls to 140 for every dollar. So now what would happen? See, still Bangladesh will still sell their shirts at the same $1. They will get 140 rupees. The cost of manufacturing each shirt is 60, and they will get a profit of 80 rupees now. Whereas the Indian company got a profit of how much? The Indian company got only 10 rupees, but now the Bangladesh company got 80 rupees. How is it possible? It is possible because of the exchange rate. Okay, so the exchange rate is moving in favor of Bangladesh and against India, but the exchange rate of India is same 70 rupees only. So what would happen? See, Bangladesh, in order to effectively capture the market, what they will do is they will try to reprice their shares to 0.5. So what would happen here is the situation and dynamics keep changing. So if they price at 0.5, India cannot price at 0.5, so India will always price at 1. At which rate US will buy? US will feel that this rate is much more favorable, and they will stop buying from the Indian company. So for the Bangladesh company, for every half a dollar they sell into 140 rupees, they will effectively get 70 rupees. The cost of manufacturing 60 rupees, and the profit per shirt will be 10 rupees. Okay, but earlier itself they got a good profit. Why should they like sacrifice their profit? It's because they can effectively shut down the competition from India. So India cannot sell their shirts to US anymore. So they cannot sell it to US anymore because their price is at $1, which is very high, and US companies will not buy at $1. They will favor the Bangladesh company. So this is called as the economic risk. So we'll have a question here. There is a risk that the value of foreign currency denominated assets and liabilities will change when we prepare accounts. To which risk does the above statement refer? It refers to translation risk. So we have another question. UCO limits its operations to exports to foreign countries. Which one of the following statements about UCO's exposure to exchange rate risk correct? So they are only like exporting their goods to foreign countries. They don't have any other business. UCO is subject to potential transaction economic translation risk. Translation risk will not come because they don't have any subsidiary. So as they don't have any subsidiary, translation risk will not come. So this option is wrong. UCO is subject to potential transaction exposures. That is correct. They are exposed to transaction. UCO is subject to economic and translation risk. Translation will again not come. So this is like up. This is wrong. UCO is subject to transaction and translation exposures to exchange rate risk. So again, this will not come because translation refers to subsidiary. So this will not come. So it would be only option B. So what is the reason which causes the forex to move? Why is the foreign exchange rates keep moving? It's because of the inflation rate with our country and the other country, the interest rate in the two countries, the balance of payments in goods and services about our country, the inward and outward foreign investment and the remittances in our country, the expectation of market participants regarding economic prospects. So if the people who are trading the currency parity, if they feel the country is going to become stronger or weaker, that will get reflected in the parity of currencies. Government policies and intervention in the exchange rate. So even governments come and buy and sell their currency and also the foreign currency. Speculation by currency traders. So they might also play a part in the movement of the currency. So these are the reasons for the movement in the parity of a currency. So interest rate parity states that the difference between the spot and forward rate is because of the differences in interest rate between two countries. So the parity difference between the fluctuation in the forex amount is actually because of the interest rate difference between the two countries. So that is what this theory states. If this were not so, then investors holding the currency with lower interest rates could switch to the other currency for say for 3 months, ensuring that they would not lose on returning to the original currency by fixing the exchange rate in advance at the forward rate. If enough investors acted in this way, known as the arbitrage, forces of supply and demand would lead to a change in forward rate to prevent such risk-free profit making. So the formula works like this. F0 refers to forward rate. So this is the rate which would be available in the future time. The current rate is known as the SO, and the IC refers to the interest rate of one country, and the IB refers to the interest rate of the another country. So if you are going to work out like this, F0 for dollar to rupee, then the S0 would have to be dollar to rupee multiplied by 1 plus I in US divided by 1 plus interest rate in India, or we'll put it as RS. Okay, so it works like this. If the above term is dollars, then here also the above term should be dollars, and the numerator here should also be dollars. If the denominator is rupee, here also it should be rupee. The divider is also a rupee. So that's how the formula works. So the second reason for the movement of forex is purchasing power parity. Purchasing power parity states that the difference between the spot and forward rate is because of the differences in inflation rate between two countries. Okay, so earlier in the earlier method, we found that interest rate was the reason for the movement in forex, but now we have come to the second theory where it states it is the inflation rate which is the cause for the forex movement. So again the formula works like this. The formula here is the same as the interest rate parity, except for the numbers here represents not the interest but the inflation rate in the respective countries. In interest rate parity you had F0, but here you have S1. S1 represents expected spot rate and S0 represents current spot rate. So we'll have a quiz. Which of the following statements relate to purchasing power parity theory? The theory holds in the long term rather than the short term. That is true. The exchange rate reflects the different cost of living in two countries. That is what inflation is. The forward rate can be found by multiplying the spot rate by the ratio of the interest rates of the two countries. No, this is not the option because we can't find the forward rate. What we can find out is the expected spot rate. Okay, so this is wrong. So we'll check the answer. So answer should be 1 and 2. So answer should be B. So the answer is B. So we'll move on to the next theory. It's called as the Fisher effect. The term Fisher effect is sometimes used in looking at the relationship between interest rate and the inflation rate. So what Fisher says is the rate of interest is seen as being made up of two parts: the real required rate of return plus a premium for inflation. Okay, so Fisher says that interest rate of any country is a reflection of two things. The interest rate in a country is a reflection of the real interest rate and the inflation rate. So this is the formula which Fisher says. So countries with relatively high rates of inflation will generally have high nominal rates of interest, partly because of high interest rates are a mechanism for reducing the inflation and partly because of the Fisher effect. Higher nominal interest rates serve to allow investors to obtain a high enough real rate of return where inflation is relatively high. So we can put it like this. If you take two countries, India and the US, as per Fisher theory, he says that the interest rate in the country, for example, if you take India, the interest rate is 15%, and the interest rate in US is something like 5%, the real rate will be constant in both the countries. So the real rate would be like 4%. So this is the same across all the countries. So that is what his argument is. Then there is a premium that has to be paid for the inflation. So the inflation is in US is just 1%. So when you add both 4 plus 1%, 4 plus 1, you get the answer 5. But what about the inflation in India? The inflation in India is 11%. So that's why we get a 15. So if you take some other country, something like South Africa, so again the same parity works. In South Africa, the interest rate might be 20%. The real rate across all the countries will be 4%, but the inflation in South Africa might have been 16%. So that's why when you add both, you get your nominal rate of interest. So we'll look at the next theory. It's called as international Fisher effect. According to international Fisher effect, nominal interest rate differentials, okay, between countries provide an unbiased predictor of future changes in spot exchange rate. Okay, so he says that the reason for the spot exchanges to move is purely because of the nominal interest rate difference in two countries. So this is the formula for international Fisher effect.